Look, I need you to understand something right now. What's happening in the silver market isn't just another price move. This is the kind of setup that comes around maybe once in a generation, and most people are going to miss it completely because they're not paying attention to what's actually happening beneath the surface. Silver just hit record highs, and everyone thinks the move is over. They're wrong. Dead wrong. And I'm going to show you exactly why the real move hasn't even started yet. Right now, silver is trading in a range that has institutional traders salivating. We're seeing a convergence of factors that hasn't occurred since the early 1980s. And back then, silver went from around $5 to $50 in less than 2 years. But here's what makes this different and potentially more explosive. The fundamentals today are actually stronger. Let me paint you a picture of what's really going on. The silver market is experiencing its fifth consecutive year of supply deficit. Think about that for a second. 5 years in a row where global demand has exceeded supply. The Silver Institute's data shows that industrial demand alone is consuming more silver than the world's mines can produce. And unlike previous cycles, this industrial demand isn't going away. It's accelerating. Solar panels are devouring silver at unprecedented rates. Every single solar panel requires about 20 grams of silver, and global solar installations are exploding. Countries around the world are racing to meet climate commitments, and silver is absolutely essential to that transition. There's no substitute that works as efficiently. China alone is installing solar capacity at a pace that would have seemed impossible just 5 years ago. But solar is just the beginning. Electric vehicles use significantly more silver than traditional cars. The average EV contains roughly twice as much silver as a conventional vehicle, and we're watching the automotive industry undergo the fastest transformation in its history. Major manufacturers have committed to phasing out internal combustion engines. That's not speculation. That's locked-in demand that will hit the market over the next decade. Then there's 5G infrastructure. Every 5G base station requires substantially more silver than 4G equipment. As telecommunications companies roll out 5G networks globally, they're creating a demand floor that didn't exist in previous silver bull markets. This is structural demand that compounds year after year. Now, here's where it gets really interesting. While industrial demand is soaring, mine supply is actually declining. The world's major silver mines are aging, production costs are rising. And here's the kicker. Most silver comes as a byproduct of other mining operations. About 70% of silver production comes from mines primarily extracting copper, lead, or zinc. When those base metal prices struggle or when those mines face operational challenges, silver supply gets squeezed even though silver prices might be rising. We're seeing this play out right now. Major mining companies are reporting production challenges. Environmental regulations are tightening. Permitting for new mines takes longer than ever. The pipeline of new silver supply is thin, and it takes years to bring new production online even if prices spike. But let's talk about what's happening in the investment world, because this is where the story gets explosive. Central banks have been accumulating precious metals at the fastest pace in decades. While they focus primarily on gold, the spillover effect into silver is massive. When institutions and sovereign wealth funds diversify into precious metals, silver becomes the leveraged play on that trend. It's more volatile, more accessible, and offers greater percentage gains when the sector moves. Exchange-traded funds holding physical silver have seen steady accumulation. But here's what most people miss. The COMEX warehouse stocks are at levels that should terrify anyone paying attention. The amount of physical silver available for delivery relative to the paper contracts outstanding is reaching critical levels. We're talking about a market structure where the claims on physical metal far exceed what's actually available. Think about what happened in the nickel market a few years ago when a short squeeze forced the London Metal Exchange to halt trading. Or look at what happened with GameStop when retail traders figured out the short interest exceeded the float. The silver market has similar dynamics, except the stakes are much higher, and the fundamentals actually support a massive price move. Major banks and institutions hold enormous short positions in silver. They've been using these positions to manage risk and provide liquidity, but they're also exposed if physical demand overwhelms available supply. And that's exactly what's starting to happen. Here's a story that illustrates what we're dealing with. Back in 2011, silver briefly touched $50 per ounce. At that time, industrial demand was a fraction of what it is today. Solar was in its infancy. EVs were barely on the radar. 5G didn't exist. Yet silver still hit $50 based primarily on investment demand and inflation fears. Now fast forward to today. Industrial demand has more than doubled. Supply deficits are structural, not temporary. Global debt levels are exponentially higher. Central banks are trapped in a cycle where they can't raise rates without breaking something, but they can't keep them low without fueling inflation. And silver is sitting at levels well below its inflation-adjusted all-time high. If you adjust the 1980 high of $50 for inflation, silver should be trading above $150 just to match that peak in real terms. We're not even close to those levels, yet the fundamental case is stronger than it's ever been. Let me tell you about something most investors don't understand: the gold to silver ratio. Throughout history, this ratio has averaged around 15 to 1. That means it took 15 ounces of silver to buy 1 ounce of gold. In modern times, that ratio has been wider, averaging maybe 50 to 1 or 60 to 1, but recently we've seen this ratio spike to over 80 to 1, even touching 100 to 1 during market stress. Right now, even with silver's recent strength, the ratio is still historically wide. If silver simply reverts to a more normal ratio relative to gold, and gold continues its own bull market, we're looking at silver prices that would shock most people. A move to a 40 to 1 ratio with gold at current levels would put silver well above $60. And that's just mean reversion, not even accounting for the supply-demand fundamentals. But here's what keeps me up at night, in a good way. The derivatives market in silver is massive. The notional value of silver derivatives dwarfs the physical market. When you have that kind of leverage in a system, and the underlying physical market gets tight, you create conditions for explosive moves that defy traditional analysis. We've seen glimpses of this. Remember the silver squeeze movement? Retail investors figured out that by buying physical silver and silver ETFs, they could pressure the paper market. The price spiked, premiums on physical silver exploded, and for a brief moment, the market got a taste of what happens when physical demand overwhelms paper supply. That was just a preview. Now imagine that same dynamic, but driven by industrial users who actually need the metal. Solar companies that can't get silver shut down production lines. EV manufacturers that can't secure supply face delays. These aren't speculators who can walk away. They need the physical metal, and they'll pay whatever it takes to get it. Quick aside here, if you're sitting on significant retirement savings, you might want to understand how precious metals fit into a retirement strategy. I put together a comprehensive guide on gold IRAs that covers how to get physical metals into retirement accounts without tax penalties. It's in the description if that's relevant to your situation. Worth understanding your options before the market moves. Anyway, back to what's happening right now in the market structure. The COMEX is the primary exchange where silver futures trade. It's where price discovery happens. But the amount of physical silver in COMEX warehouses relative to open interest, the number of contracts that could demand delivery, is reaching levels that historically precede major price moves. Here's how this works. Most futures contracts are settled in cash. Traders don't actually want physical delivery. They're just speculating on price. But when physical users start standing for delivery, when they actually demand the metal, the exchange has to deliver. And if there's not enough metal available, prices have to rise until holders are willing to sell. We're starting to see signs of stress in this system. Delivery notices are increasing. Warehouse stocks are declining. Premiums for physical silver over paper prices are widening. These are all indicators that the paper market is losing its grip on price discovery. And here's the geopolitical angle that nobody's talking about. Countries around the world are diversifying away from dollar dependence. The BRICS nations are exploring alternative payment systems. Trade is increasingly settling in currencies other than dollars. When countries lose faith in fiat currency systems, they turn to hard assets. Gold and silver have been money for thousands of years. They're nobody's liability. They can't be printed or debased. China and Russia have been accumulating precious metals for years. They understand what's coming. They're positioning for a world where hard assets matter more than paper promises. And when sovereign nations compete for physical metal, prices don't move in small increments. They gap higher in ways that leave retail investors scrambling. Let me tell you about the last major silver bull market. In the late 1970s, the Hunt brothers tried to corner the silver market. They accumulated massive positions, and silver went from around $5 to $50. Eventually, the exchange changed the rules. Margin requirements were raised, and the market crashed. The Hunts were wiped out. But here's the difference today. This isn't about manipulation or cornering. This is about fundamental supply and demand. Industrial users need silver. They can't function without it. And there's not enough supply to meet demand at current prices. No exchange can change the rules to fix that. The only solution is higher prices to incentivize more supply and ration demand. The solar industry alone is projected to consume more silver in the next decade than exists in all known above-ground stockpiles. Think about that. Even if every ounce of silver sitting in vaults ETFs and private hands came to market, it wouldn't be enough to meet just solar demand, let alone all the other industrial uses plus investment demand. This is why I say we're looking at a potential $10 move. And honestly, that might be conservative. If silver moves from current levels to just $40, that's roughly a $10 move. But given the supply-demand dynamics, given the monetary instability, given the industrial demand trajectory, a move to $50 or beyond isn't just possible, it's probable. Here's what most people don't understand about commodity bull markets. They don't move in straight lines. They're volatile. There are pullbacks that shake out weak hands. But the overall trend, when driven by fundamental supply-demand imbalances, is relentless, and the moves at the end of these cycles are parabolic. Look at what happened with uranium. For years, uranium prices languished. Mines shut down, supply dried up. Then, as nuclear power came back into focus and utilities needed to secure supply, prices exploded. Uranium went from $20 to over $100 in a relatively short period. The fundamentals finally overwhelmed the paper market. Silver is setting up for a similar move, except the market is larger, more liquid, and the industrial demand is more diverse and growing faster. When this move starts in earnest, it's going to catch most investors completely off guard. The smart money is already positioning. Look at what mining companies are doing. They're not expanding production aggressively despite higher prices. Why? Because they know the costs are rising faster than prices. They know that the easy silver has been mined. They know that environmental and permitting challenges make new projects difficult. They're being cautious, which means supply will remain constrained even as prices rise. Meanwhile, industrial users are starting to panic. Procurement managers at solar companies are securing long-term supply contracts. EV manufacturers are locking in metal supplies. These aren't speculators. These are companies that need physical metal to operate, and they're willing to pay up to ensure supply. This is creating a squeeze from both sides. Supply is constrained and declining. Demand is growing and becoming more urgent. And the paper market that has kept a lid on prices for years is losing its ability to control the narrative. Here's another angle most people miss. Silver is tiny compared to other markets. The entire silver market, all the silver in the world, is worth less than the market cap of many individual tech companies. It wouldn't take much capital flowing into silver to move prices dramatically. And when institutional investors start allocating even a small percentage of portfolios to precious metals, the impact on silver prices is enormous. We're already seeing this begin. Pension funds are increasing commodity allocations. Sovereign wealth funds are diversifying into hard assets. Family offices are buying physical metals. These are long-term, patient investors with deep pockets. They're not trading in and out. They're accumulating and holding. And here's the kicker. Retail investors haven't even shown up yet. The general public isn't talking about silver. It's not trending on social media. Your neighbors aren't asking you about silver prices. That's actually bullish because it means we're still early in this move. When retail FOMO kicks in, when everyone suddenly wants exposure to silver, that's when prices go parabolic. Think back to any major bull market. The biggest gains come at the end, when the crowd finally notices and piles in. We saw it with tech stocks in the late 1990s. We saw it with housing in the mid-2000s. We saw it with cryptocurrencies in 2017 and again in 2021. The pattern is always the same. Early accumulation by smart money, followed by a steady rise that builds momentum, followed by a parabolic blow-off top when everyone wants in. Silver is in the early accumulation phase. The smart money is positioning. The fundamentals are aligning. The supply-demand imbalance is growing. And most people are completely unaware of what's building. Now, I'm not saying this happens overnight. Markets take time to develop. But the setup is there. The ingredients are in place. And when this move starts accelerating, it's going to be one of those moments where you either positioned ahead of time or you're chasing prices higher, wishing you had acted sooner. Here's what you need to understand about timing. Nobody can predict exact tops and bottoms, but you can identify when risk-reward is heavily skewed in one direction. Right now, with silver having pulled back from recent highs, with sentiment still relatively subdued, with the fundamentals stronger than ever, the risk-reward is extraordinarily favorable. If you're wrong and silver goes lower, the downside is probably limited. Industrial demand provides a floor. Central bank policies provide a floor. The supply deficit provides a floor. But if you're right, if this supply-demand imbalance plays out the way fundamentals suggest, the upside is massive. This is the kind of asymmetric opportunity that doesn't come around often. A $10 move in silver from current levels represents a significant percentage gain. But more importantly, it represents a recognition by the market that silver is undervalued relative to its industrial importance, its monetary properties, and its supply constraints. The institutions that are accumulating silver right now understand this. They've done the analysis. They've looked at the supply-demand data. They've modeled out the industrial demand growth. They've assessed the monetary instability, and they're positioning accordingly. The question is whether you're going to wait until everyone else figures it out, or whether you're going to position now while the opportunity is still available. Because once this move really gets going, once silver breaks through key resistance levels and momentum builds, the easy money will have been made. I've been watching precious metals markets for years, and I've never seen a setup quite like this. The confluence of factors, industrial demand growth, supply constraints, monetary instability, geopolitical tensions, technological transformation, it's all pointing in the same direction. And that direction is significantly higher prices. The silver market is gearing up for a move that's going to redefine what investors think is possible in this sector. A $10 move isn't just likely, it might be conservative given how tight this market is becoming. And the investors who recognize this now, who position before the crowd, are going to be the ones who capture the bulk of this move. This is your once-in-a-lifetime opportunity to get positioned in an asset that's fundamentally undervalued, structurally constrained on supply, and facing explosive demand growth. The setup is there. The fundamentals are there. The question is whether you're going to act on it or watch from the sidelines wishing you had.